Open to markets now. I'm Michelle Rook along with Arlan Suderman with StoneX Group. And Arlan, we did close mostly higher in the livestock futures, mixed in the grains, but the corn market did have a higher close. And of course, weather part of that, wasn't it?
Yeah, weather really is. The trade is reacting to disappointing rain totals over the weekend. And that's not a surprise. And when you look at this type of system, when you have a drought in existence, it takes some time to re-energize the atmosphere, put moisture back in the atmosphere, so to speak. If we look at an El Nino weather pattern, the type of rainfall that we're going to get is from these convective thunderstorms that come down slope around the high pressure, kind of the ring around the high, so to speak, and the northwesterly flow we get out of Canada at times. That type of thunderstorm activity is really difficult for the models to pick up ahead of time. And so they really don't show it. So you're going to look at the GFS or you look at the European model, those straight model runs, and they're going to show very little precipitation a lot of times. And this coming week is a good example of it. There are several opportunities we suspect that over the next 7 to 10 days, we're going to have 3 to 4 opportunities for disturbances to come down slope through that airflow and create clusters of thunderstorms that move across the Midwest. And frankly, forecasters who have been pretty well nailing this over the last several months and the last several years that I talk to every day have a high degree of confidence that we're going to see things fill in. I know not everybody got it, especially in the northern Midwest over this past week. And that's the weekend. That's the area that we said was most at risk of missing out. Now we're seeing some opportunities come and fill those areas in and give us more rain. Probably not as much as what we'd like, but with the cooler temperatures, it's certainly going to be timely rain, and that's going to be key.
But this afternoon, as we tape this, it's before we get crop ratings out. We're expecting a drop in crop ratings, and some are translating that into lower yield, which as an agronomist, is it too early for that?
Yeah, it really is. And probably the tweet that I enjoyed the most is one that said, estimating yields in June is like taking a pregnancy test before you've had sex. And so I think it's just premature to be looking at yields. I have my yield models that are cranking out numbers, and I'm not publishing them because they're worthless in June. The correlation is so poor. We start getting into July, you start having a little bit more correlation there, then we can start talking about yields. But the crop ratings do matter to the market and do affect money flow. I am expecting lower crop ratings for both corn and soybeans, and we may even see some instability next week in some of the state ratings. It's going to take a little bit of time to turn this around, but I do think the pattern is still favorable, that we will be able to do so. Most concerned about the area kind of around the Great Lakes, make sure everybody gets those areas filled in going into the northwestern Midwest.
So December corn looks like 550. We're going to get above that perhaps with this run, huh? That's kind of critical, isn't it?
Well, yes. And once you break through these areas of chart resistance, so to speak, then the momentum trading algos kick in and add more buy orders and magnify it. Just remember that the market takes the escalator up and it takes the elevator down. In other words, we can lose this in a hurry, and it may be just like the next forecast that does it if it shows a really wet forecast. But right now we need to be watching these opportunities and take advantage of them when they occur.
Mixed trade in the soybeans. The November beans obviously tried to follow corn, but again, a little early for putting weather premium in that market too. That's an August crop, isn't it?
Yeah, it really is. And soybeans, subject to the same risk where rainfall isn't there, but it has more time that it can take and waiting for those rains to happen as long as you can sustain the plant. So I'm less worried about soybeans right now. If the pattern, if they stay dry, then we'll worry about that later. The opportunity is still there for soybeans to do well. And so right now it's just the funds making their macro decisions, painting with a broad brush, saying, oh, it didn't rain as much as we thought it would, so let's buy corn and soybeans, focusing on the new crop contracts. Of course, those old crop contracts under pressure with the Goldman roll, which has another day left in it. So we may see something similar tomorrow as well.
But a lot of the elevators have already rolled from their bids off of July into the August already. That's part of that roll too, isn't it?
Yeah, and even into the November in some cases. So that's something that happens every summer. It may be frustrating to farmers because you can lose basis at times when that happens as well. And another reason to manage your risk exposure in your cash marketing.
Right. So the wheat market was choppy, but we managed to be steady to just a little bit better. What is the market trading right now? Because I know globally we're not very competitive. So what is it that the market's really focusing on?
Well, one thing I think is very important when you look at the wheat market is that wheat is the one commodity that is mostly traded on the cash market versus soybeans, for example, where nearly every bushel consumed in the world is traded on the futures market at one time or another. Just a very, very small fraction of the world wheat crop is traded on the futures market. So a lot of times there's a disconnect, but fund managers trading this wheat market are looking at the fact that we had an Egypt tender last week in which it looked like Russia is going to enforce the $240 per minimum price per metric ton. And that provides kind of a floor under the global market. So they already have big short positions in Chicago wheat. Why would you want to add to that when Russia's putting a floor under the market, but not really anything there to justify sustaining a rally at this point when we can't really compete on the world market?
What's your thought about the cattle market? We put in key reversals last week, but we're back up today. And we had thoughts of or talk of record cash trade again for this week. So if we do have record cash, will we go back up and retest those highs, do you think?
Yeah, great question. 185, 186 in the Southern Plains last week, 190 on a live basis in the Northern Feedlot District, 300 on addressed. It's just an incredible cash market. So why did the board stall out? Well, the funds seem to be still adding to their ownership, and that's making the feeders very uncomfortable. So they're taking advantage of these high prices, and we're seeing a lot of heavy hedge activity. That's why the board's not keeping up with the cash right now. It's because of producer hedging is a big part of that.
So you think this was a healthy correction in an otherwise bigger bull market?
Yeah, absolutely. The market was definitely overbought and it was vulnerable. And I like the way the feeders are using some risk management strategies in here to lock in some opportunities.
Hogs had a higher weekly close last week. Cash and cutout values up here today. Can that market keep going?
Well, it can, but I think initially it's a little bit too fast, too quickly, and had to do a little consolidating. But it looks like both the futures and the cash and even the product market are showing signs of a bottom. So that's encouraging right now. And a big part of that was the Prop 12 out of California, when California told industry that they were going to give some leniency in the transition period. That took worries off that we were going to see a lot of hogs dumped on the market all at once or a lot of product. That didn't qualify for Prop 12 in California. And we're seeing a lot lighter hog weights right now with a little lighter slaughtered numbers. That's reducing the amount of pork going on the product as well and providing opportunity for us to get a little bounce in this market.
Yeah, and it looks like the funds are having to cover some of that record long short that they had put in place. All right, one last question I want to ask you about. We have CPI out tomorrow. We have the Fed meeting this week. What are the Fed funds futures rates telling us about what the Fed is going to do on Wednesday? Are they going to go up a quarter point or not?
I think the expectation is to have a hawkish pause. In other words, they'll pause, but they'll have a lot of rhetoric saying more rate hikes are coming. And if you look at the data, it's not hard to see why the Fed would want to boost rates some more. We're seeing a labor market that is starting to tighten up once again. Job openings are increasing once again. A lot of the signals that the Fed has been watching that's been driving their decision are saying more hikes are needed.
Thanks for your analysis. As always, that is Arlan Suderman with StoneX, and that's Markets Now.